This is one of the key building blocks for building wealth. It's one I would never recommend anyone go without, and it should be top priority for you, for anyone, wherever they are in their wealth building journey for that matter. You've probably heard this a million times. You need an emergency fund. But there's so much conflicting advice. How big should it be? Where should it be? And what do you even use it for? Well, in today's episode, we're talking all about emergency funds. I got so many questions from you. We'll talk about where to keep them, how to determine how big it should be, which accounts to hold it in, but also should it be invested. But first, before we start, if you want to get your money in order, I finally have made my money system available for you to use. It's a system I use on a monthly basis to track my finances, to set goals, and to track my investments. And to be honest, it's the first thing that really helped me make a big impact on my investment portfolio. And it helped me add $50,000 in the first year of using it. Also, when you buy it, you get 2 bonus videos on how to use the tool, and you get the best way to budget, including some other tips that I have on monthly budgeting and how to set goals. Because once you set goals, you know exactly where your money should be going when you get paid every month. So back to emergency funds. The first most popular question is, how big should my emergency fund be? If you've watched my content, you have probably seen that I would say between 3 to 6 months of living costs. This is because if anything happens, if there is a COVID scenario and you might be in a job where you could easily lose your job, then you want to at least be able to cover yourself for 3 to 6 months of living costs. The more job security you have, or for example, the less dependents you have, you can have a smaller emergency fund. So it's very dependent on your individual circumstances. But here are a few scenarios where I would look at holding an emergency fund of even bigger than 6 months. When you're the sole breadwinner in the house and you've got more people that relies on your salary than just you. When you're self-employed, or if you're a business owner, because if you don't have stable or predictable income, then you need a little bit of a bigger buffer in your emergency fund. Also, if you own assets like properties or multiple cars or even other businesses, then having a big emergency fund is good because you have more things at risk and more things that can go wrong and that might unexpectedly need cash flow from you. And then if you're in a job that's not very stable and you could easily lose your job or be without a job for a few months, then you should definitely look at holding an emergency fund of between 6 to 12 months of living costs. But if you're a single professional that's in a corporate job and it's very stable and you've been working at the same company for a few years and you don't plan on making any career moves, then a 3-month emergency fund should be sufficient. So many people ask, what do I do with my emergency fund and how big is it? So I actually recently decided to increase the amount of cash I hold in my emergency fund. And that's just really because there's a lot of change happening in our family. We're looking at moving. We're looking at potentially buying a property, which is something that I will need to make a whole different video about. We're also changing careers and businesses. My husband is setting up his own business. I've been doing my Money with Carla business for 20 months now. So there is a little bit more risk going on. We've got a son and we have another one, daughter on the way in a few months. So we want to prepare. I want to have more peace of mind around this. And although I'm all about having the maximum amount in my investment portfolio for long-term growth, I have realized that having a good chunk of cash in my emergency fund gives me a lot of peace of mind personally. And when I read about Morgan Housel, you know, he's one of my favorite financial or money authors. He writes about how much he holds more cash than any advisor would ever recommend him to hold because it gives him peace of mind and it helps him sleep at night and he knows that he will be able to provide for his family should something go wrong. After reading that, it actually made me think quite a lot about my personal situation and also how I obviously continue investing in the stock market. That's not something I'm going to stop, don't worry. I just hold a little bit more cash aside because of the business I'm running and the risk we're taking on the professional front and because our family is expanding. I think that makes sense. Where I hold my emergency fund, that's a different question. I actually hold it, this is like not necessarily recommended by the way, because I hold mine in a savings account in Switzerland, and this is an account that doesn't earn any interest. But it's obviously held in a very strong currency, the Swiss franc, which has gained a lot of value against the US dollar, and it's one of the strongest currencies in the world. So despite it not earning interest for me, it does hold its value quite well, and relative to other currency increases in value. But that being said, this is not something unnecessarily. I could actually put it into, move it into my interactive brokers account and hold it in a money market fund there, for example, where I could earn more interest. But for me, I just really want it accessible in an account. Should I need to put it down for a house deposit or an office that, we're potentially considering buying? We also recently bought a car, so I want the cash very accessible, no volatility, exposed to no volatility. So that's the story. It's not necessarily perfect, but at this point, it's what makes me feel good. So just a little bit of background on that, and perhaps some insight to see that it's definitely not an exact science. Also, by the way, you might be wondering why I don't earn any interest. So in Switzerland, we don't earn interest on savings accounts. Switzerland has actually a few times been in a negative interest rate environment, which is something that people are usually super surprised by, where technically the bank should be charging you to hold your money for you instead of them paying you an interest to hold the money for you, which is a really, really interesting scenario. But banks don't enforce this. They don't pass that on to the retail account holders. So in essence, they don't pay any interest, but at least they're not charging me interest to hold their money. So that's kind of a good introduction to the next question, is where should you keep your emergency fund? This was actually the most asked question, because a lot of people hold their emergency fund in an access bond. For example, if they have a mortgage on the house, some mortgages allow you to hold an accessible amount of cash there, so you can withdraw from that at any time. So instead of holding your emergency fund, let's say it's 200,000 in a savings account where you earn interest on it, let's say for argument's sake, the interest rate would be 8%. This is before tax. You could potentially earn 8%, but the interest rate on your mortgage is 10%. Then, of course, you would rather have that money in your mortgage where you're saving. It's helping you save on interest as long as you're not using it, rather than having it in an account where you're earning less interest than what your mortgage is costing you. So there's kind of a little bit of a trade-off decision to be made there. So many people want to know whether this is a good strategy. And honestly, if your mortgage or your access bond is easily accessible to you and you can withdraw from it this evening or tomorrow if you need that money, then I honestly think it's not a bad idea. If you don't have a mortgage or access bond, where should you hold your emergency fund? So here are a few places where you should not be holding it. It should not be exposed to the stock market or to any volatility, and it should definitely not be invested in crypto. Also not in property, because that is really hard to sell. And if you need that money when something goes wrong, you don't want to be in a position where you can't sell the asset to get the cash, or you might potentially have to sell, like for stocks or ETFs, although it's very easily accessible and I can literally sell my stocks tomorrow and get that money into my bank account, or by the end of today if the stock market is open. But why you don't want it in there is because it is volatile, and if the stock market drops, let's say like during COVID, the stock market dropped and a lot of businesses had to close down. So this is the worst time if you need money to take money out of the stock market, if your emergency fund is held in the stock market. So I really want you to think about your stock market investments as long-term investments, and your emergency fund is really something that's completely separate. It's not exposed to volatility. The intention is not to have it grow massively over time, but rather to give you a bit of a safety buffer and some peace of mind. So if you're going the route to put it in a savings account, obviously you want to look for a high yield savings account. I would say putting it in a separate account is smart, so that you don't mix it up with your daily expense cash. And you definitely don't want to use that in case you run out of money in a certain month, or if you're deciding to go on a holiday or buy a gift for someone's wedding. That money should be separate and really should be break glass in case of emergency kind of money, and not something that you're just dipping in and out of when you need money for something. But getting a highest possible interest rate is smart. You can also potentially consider a money market fund, but you want to make sure it's in a fund where you can easily access it. And to be honest, in terms of returns, I would compare what I would be able to get at a savings account as an interest rate and what I would be able to get in a money market fund, and what the interest rate or the return on the money market fund has been over the last 10 or 20 years, depending on what data is available to you. Once you start looking at interest rates, you might be tempted at putting your money away, or your emergency fund cash away, in a notice deposit, because the longer you lock your money up for in a notice deposit or a fixed deposit, the higher interest rates you're getting. And this is basically the bank saying, okay, we've got some certainty on how long you will hold this money with us, so we're going to give you an incentive to hold it here with us for longer. We're going to pay you a higher interest rate, because when we know how long we're going to have this cash with us on our balance sheet, then at least we as the bank can plan on where we're going to lend it out to and how long we can lend it out for. So This is really the way for the bank to incentivize you to hold the money with them for longer periods by giving you higher interest rates if you commit to a longer period. But for emergency fund, this is obviously not smart, because if you need money in an emergency, you're going to need it now. And you can't wait or give notice for 32 days, for example, or even 7-day notice. It might be too long. If someone ends up in hospital, or your pet needs urgent medical care, or you lose your job and you have to pay your rent, predicting the timeline for that is sometimes really hard. So you don't want to be in a position where it's locked up for 32 days. Of course, unless you have family members that you can rely on, because that might make your emergency fund situation look completely different. I've sometimes spoken to students where they don't even live off their own income. For example, they have their parents covering all their costs. In that case, having a small emergency fund might be necessary, but not even 3 months. Because if something goes wrong in this case, they don't have their own income, they rely on their parents, then it might not even be necessary to have a big emergency fund. That's really dependent on your unique situation. So if you feel that there would be someone that, would be able to cover for you, that you could call up if something goes wrong. But I wouldn't necessarily rely on that strategy. And that's really because if there is something that happens like COVID, everyone might be affected. A lot of people's jobs might be at stake. Or a global financial crisis, for example, then you don't want to put the kind of pressure on someone else to cover your emergency costs. In general, I don't like the strategy of relying on family members for emergencies or for any other financial matters for that matter. Okay, so maybe that was a little bit too long spent on that question. If all this talk about emergency funds is making you question your current strategy, and if you're putting away enough towards your emergency fund or your investments, or just if you've got your monthly spending under control, I have got an amazing system that I use for my own money, and I would 100% recommend to you. I think you've probably not heard me recommend anything 100% on this channel, so I must be quite confident about this one. But I would definitely recommend that you check out my money system. It's linked in the caption, and it can really help you take control of your spending, set goals, and make some good progress towards building your investment portfolio. Another popular question is whether I should be using my tax-free savings account for my emergency fund. I actually thought I've made this clear quite a few times, but just some background. Different countries have different ways that incentivize you to plan and invest towards your retirement. One of those, for an example, is a tax-free savings account. In South Africa, it's called a tax-free savings account. You actually have one in Canada that works in a similar way, although your options that you can invest in and the amounts are different. In the UK, you've got an ISA, and in Switzerland, you've got a Pillar 3A. The thing about a tax-free savings account in South Africa is that you have a 500,000 lifetime limit. So if you put money in, 36,000 Rand a year is the annual limit. You put that in every year. If you take any money out, that basically you're not getting that a contribution room back again. So it's like a high level watermark. If you think about the watermark moving up, and if you take any money out, the watermark doesn't go down. That's counted towards your 500k lifetime limit. So you don't want to take money out of your tax-free savings account. Also, your tax-free savings account is your one chance at tax-free investing in South Africa. This is one account where you can be buying foreign ETFs, for example. You can buy 100% foreign ETFs within this account. And as I mentioned earlier, you don't want to put your emergency fund in the stock market or expose it to the stock market, because that's a volatile place. So those are the two reasons that your TFSA should not be used for your emergency fund. Your emergency fund should be a separate account, because your TFSA, you don't want to take money out. Also your TFSA, you want to invest, and your emergency fund is not the account that should be invested. I hope that one makes sense. So if you've already done this and you've basically used your TFSA as your emergency fund, don't panic, but definitely don't withdraw it, because now you've already made contributions towards your lifetime limit. You are able to use that money and take it from a cash account into an investment, or take it from a savings account where you're getting interest into an investment account. You can transfer your TFSA between providers, but also if you're with a provider that allows you to buy ETFs, for example, then you can just move the funds within your TFSA from being in an interest-bearing investment towards a stock market investment, if that's what you want to do. So my last tip on emergency funds is to adjust it as your living costs increase. You might have set your emergency fund goal 5 years ago when your living costs were quite low, your life was still simple, you might have been single and now you're married, for example, or you've got a child on the way. Then that could mean right now your emergency fund definitely needs to be revisited. I would say at least annually check in on your emergency fund and make sure that you can at least cover 3 to 6 months of living costs or a bigger amount. As I've mentioned earlier in this video, revisit your goal annually and make sure that it's large enough and that you can actually, as your living costs increase over time, or if your family situation becomes more complex or you have people, more dependents and more people depending on your income, that your emergency fund makes room for that. I hope this answers most of your questions on emergency funds, but if you've got anything that's not answered, please let me know in the comments and I'll try and help. See you next time.